The first time I realized something had changed forever in the market, it wasn't during a crash. It wasn't during a panic sell, or a surprise rate hike, or a black swan headline. It was a quiet night. I was sitting in front of my screen, watching price move in a way that felt wrong. Not chaotic, not emotional, but cold, precise, almost surgical. Every breakout failed by a few ticks. Every stop cluster got swept, cleanly, efficiently. Price didn't hesitate. It didn't overreact. It didn't behave like a crowd. And that's when the thought crossed my mind for the first time. This doesn't feel human anymore. For most retail traders, AI in trading sounds exciting. Faster analysis, smarter entries, automated profits. A promise that technology might finally level the playing field. But for someone who has been in the markets for 15 years, that night felt different. It didn't feel like opportunity. It felt like standing at the edge of a battlefield and realizing the other side had just brought in a weapon you didn't even understand yet. I remember when trading was simpler. Not easier, but simpler. Back then, markets moved because people were scared, or greedy, or wrong. You could feel the hesitation in price. You could sense when a move was driven by emotion rather than intention. And if you were patient enough, disciplined enough, you could survive by reading that human behavior. But today, price reacts in milliseconds. Patterns appear and disappear before your brain can even register them. Liquidity vanishes, then reappears somewhere else. And the market no longer waits for you to understand. Retail traders ask me all the time, is AI going to help us win? Should I be using AI tools? Will AI replace discretionary traders? But those questions are already late. The real question is much more uncomfortable. What happens to a market built on human psychology when the dominant players are no longer human? Because AI doesn't feel fear, it doesn't hesitate, it doesn't hope. It doesn't revenge trade after a loss, it doesn't over-leverage after a win, and most importantly, it doesn't make the same mistakes twice. For years, retail traders have been told that the enemy was emotion, that if they could just control themselves, fear, greed, impatience, they would finally win. But what if the next enemy isn't inside you, but across from you? What if the market you're trading today is no longer a reflection of human weakness, but a system designed to exploit it with machine-level precision? I've lived through multiple eras of the market: manual trading, indicator overload, algorithmic execution, high-frequency trading. And every time technology entered the game, retail traders believed the same thing: this will make trading easier. But it never did. It only made the game more asymmetric. Because technology doesn't remove risk, it concentrates advantage. And now, with AI stepping fully into trading, not as a tool, but as a decision maker, we are standing at another inflection point. One that will decide who adapts and who quietly disappears from the market without ever understanding why. Before we talk about strategies, tools, or opportunities, we need to confront something much more uncomfortable. Because the biggest danger of AI in trading is not that it exists, it's that most retail traders are still approaching the market as if the rules haven't changed.
For most retail traders, the first mistake with AI isn't using it too early. It's believing that AI is here to help them. That belief usually comes from the same place every trading illusion comes from: the desire for relief. Relief from uncertainty, relief from responsibility, relief from the constant emotional burden of decision-making. I've seen this pattern before, many times. When indicators became popular, traders thought indicators would remove subjectivity. When trading bots appeared, traders thought automation would remove mistakes. When signal services exploded, traders thought outsourcing decisions would remove losses. And now, with AI, the fantasy has returned in a new form. Let the machine think for me. Let the model decide. Let the algorithm see what I can't. But here is the painful truth most traders avoid. Every time retail traders outsource thinking, they don't remove risk, they blindfold themselves. Because the market does not punish ignorance gently, it punishes it silently. I've watched traders feed AI models with bad data and trust the outputs anyway. I've watched traders follow AI-generated signals without understanding context. I've watched accounts grow quickly and then collapse even faster. Not because AI failed, but because the trader never knew why anything worked in the first place. The pain always arrives later. It arrives when the AI stops performing, when market regimes shift, when volatility changes character, when liquidity behaves differently, and the trader, stripped of intuition and understanding, has nothing left but confusion. That's when panic returns. That's when revenge trading comes back. That's when the illusion breaks. The real mistake is not trusting AI too much. The real mistake is thinking AI changes the nature of the game. It doesn't. It only amplifies existing power imbalances. Because while retail traders are using AI as a crutch, institutions are using AI as a weapon. This is where the realization begins. AI in trading was never designed to help small traders win more consistently. It was designed to execute faster, adapt quicker, and exploit inefficiencies at scale. Institutions don't use AI to predict markets. They use it to interact with liquidity. They use it to detect where orders are clustered, to anticipate behavioral responses, to react in microseconds to changes retail traders won't see for minutes, if ever. AI doesn't care about chart patterns. It cares about where pain will be felt next, and that's the revelation most traders don't want to face. The market is no longer just a psychological arena. It's a feedback system between human emotion and machine optimization. Human fear creates predictable behavior. AI learns that behavior. AI exploits it, and the loop tightens. Stops get cleaner, fake breakouts get sharper, reversals get faster, and mistakes get more expensive. At some point, you stop asking, "Why does this keep happening to me?" and you start realizing something far more unsettling. This is happening because I am still playing a human game in a market that has already moved on. That moment, when you truly see this, is uncomfortable because it forces a choice. You can keep searching for better tools, better indicators, better AI prompts, or you can step back and ask a much harder question. What role does a human trader still have in an AI-dominated market? The answer is not obvious, and it's not comforting, but it's the only place where real survival begins.
To understand what AI really means for trading, you have to stop thinking of it as a tool and start seeing it as an environment. Most retail traders imagine AI as something external, a bot, a model, a piece of software they can turn on or off. But that's not how institutions see it. Inside professional trading desks, AI is not making trades the way humans do. It's not asking, should we buy or sell here? It's asking a much colder question. Where will liquidity be forced to appear next? That shift in perspective changes everything. Markets have always moved toward liquidity. That part isn't new. What's new is how precisely that movement can now be engineered. AI systems ingest vast streams of data, not just price and volume, but order flow, execution latency, volatility clustering, behavioral patterns, and response timing. They don't analyze charts the way retail traders do. They analyze reaction probability. Where do traders panic? Where do they hesitate? Where do they place stops because it feels safe? AI learns this, not once, but continuously. And once it learns, it doesn't forget.
This is why modern stop hunts feel different. They're no longer sloppy, they're efficient. Price moves just far enough to trigger pain, then snaps back with no remorse. From the outside, it looks like randomness. From the inside, it's optimization. I've seen this evolution clearly in one particular space: highly liquid index futures during low liquidity sessions. Before, fake breakouts would overshoot. You could sometimes fade them with experience. Now, the move is smaller, faster, cleaner. Stops get taken, but only just. Entries get trapped, but only briefly. And by the time your brain registers what happened, the opportunity is gone. This isn't because the market became smarter. It's because the market became faster at exploiting predictability. And here's the part most traders miss. AI doesn't eliminate human psychology, it feeds on it. Retail fear hasn't changed in decades, greed hasn't changed, impatience hasn't changed. What has changed is the speed at which those emotions are detected, quantified, and acted upon. This creates a brutal asymmetry. Retail traders are still learning patterns visually. AI systems are learning patterns statistically across millions of instances. Retail traders react after price moves. AI reacts before humans even feel discomfort. To make this concrete, consider a simple case. During periods of rising volatility, retail traders tighten stops. They believe they are managing risk. AI sees this behavior as fragile liquidity. Clusters of tight stops become targets, not because the market wants to go there, but because the probability of forced execution increases. Price nudges, stops trigger. Liquidity releases, price reverses. From the retail perspective, it feels unfair. From the AI's perspective, it's just math. This is why AI-powered trading doesn't need to predict direction. It only needs to predict behavior under pressure. And this is where opportunity and nightmare diverge. If you are still trying to out-predict the market, AI is a nightmare. You will always be slower, you will always be late, you will always be reacting to something that has already been processed. But if you shift your role from predictor to observer, something changes. Human traders still have one advantage AI does not: context. AI sees probabilities. Humans can see meaning. AI doesn't understand why a central bank decision matters. It only understands how price reacts. AI doesn't understand regime change. It adapts after the fact. And AI doesn't suffer when it's wrong, but it also doesn't know when not to play. This is where experienced traders can survive, not by competing with AI on speed, not by copying its tools, but by positioning themselves where AI is least effective during uncertainty transitions, regime shifts, and narrative breaks. The traders who survive the AI era won't be the fastest, they'll be the most selective. They'll trade less, wait longer, and understand when the market is being optimized versus when it is being redefined. That distinction is subtle, and it's invisible to anyone still chasing signals.
At some point, every trader who survives long enough reaches the same conclusion. You don't win by fighting the market harder. You win by standing in the right place. In an AI-driven market, that place has shifted. The first adjustment is not technical, it's psychological. You have to stop measuring your value by how often you trade. AI thrives on frequency. Humans don't. The more often you feel the urge to act, the more likely you are stepping into a zone where machines have already mapped your behavior. Patience is no longer a virtue, it's camouflage. The second adjustment is learning when not to participate. AI systems are most effective in environments they can optimize: stable regimes, repetitive behavior, predictable reactions. When conditions are clean, liquid, and orderly, AI dominates. But when narratives shift, when macro assumptions break, when correlations snap, machines hesitate, not emotionally, but structurally. They need data to adapt. Humans can sense meaning before data confirms it. This is where discretion still matters. Not the kind driven by impulse, but the kind built on experience, knowing when the game itself is changing. The third adjustment is accepting a smaller role. This is the hardest one. Most retail traders dream of scale, more size, more trades, more activity. But AI punishes scale without edge. Survival in this era looks quieter. Fewer trades, more waiting, more capital preserved for moments that actually matter. It's not glamorous. It won't impress anyone on social media, but it works. And once you internalize this, something unexpected happens. Fear loses its grip. You stop feeling chased by the market. You stop trying to keep up. You stop believing you need to outsmart something designed to be faster than you. You begin to trade with intention again. That is the real opportunity of AI in trading. Not the promise of automation, not the illusion of effortless profit, but the pressure it creates, forcing human traders to evolve, to become more selective, more aware, more honest about their limitations. Because the nightmare was never AI itself. The nightmare was believing the market would stay human forever. If you are still here, still trading, still learning, still questioning, then you already have something machines don't: judgment. And judgment, when paired with humility, is still the rarest edge in the market. If this perspective resonates with you, stay with this channel. Not because I have answers, but because this is where we ask better questions, together. Leave a comment and tell me what worries you most about AI and trading. Subscribe if you want to keep exploring how markets are changing beneath the surface. Because in the end, mastering the market was never about beating technology. It was always about mastering yourself. Master yourself. Master the markets.